Hello and welcome to the latest instalment of Investment Insights. I'm Toby Laws, Senior Reporter at ETF Stream. I am delighted to be joined today for this discussion on synthetic ETFs by Ross Finlayson, Head of Markets and Product Strategy at Amundi ETF and Indexing, and Terry McGivern, Senior Research Analyst at AJ Bell. Guys, thanks for joining us.
Thank you for having us.
Ross, why should investors consider synthetic replication today, and how do you explain its core advantages versus physical?
Yeah, so physical and synthetic ETFs are ultimately very similar in what they deliver for the end client. Obviously, the difference, or the main difference, is how they achieve that replication. So if we think about a physical ETF, when a unit gets created or cash is added to the fund, that cash is used to buy the underlying securities, and they sit in the fund. Then ultimately, it's the performance of those securities, the portfolio management, the fees, and any other costs associated with monitoring and running that portfolio, which will deliver the performance. In a swap ETF, when a unit is created, the cash is not used to buy the underlying securities. It's used to buy what we refer to as a substitute basket. And this substitute basket ultimately acts as the insurance that sits in the fund and is owned by the fund if there were to be a credit event or something along those lines. The performance is delivered by a contract with an investment bank who will deliver the performance of that exposure, X of any other portfolio management frictions. And obviously for that, there is a swap fee. So the benefit and where we see adoption in synthetic ETFs is ultimately where there is more efficient market access entirely, or transaction costs, where the investment bank is better placed to replicate that exposure rather than buying the direct underlying securities.
Great. So Terry, coming to you, when you evaluate replication methods, what are the deciding factors that make synthetics worth considering in the portfolio?
Well, when we're looking to select a product for our portfolios, it's always, a full holistic view of what's going to be not only a good product in and of itself against its own benchmark, but also a good product in our portfolios. We've got strategic asset allocation benchmarks that we have to track. So when we're looking at, all of the different dimensions that we consider in our research, replication method is an important one. We know that physical replication is generally makes sense in things like core equity type markets. We know that in fixed income type products, sampled or optimized replication is generally a better fit because of the much broader indices and the number of issues that are in them. And then there are some pockets in some markets where we look and we see synthetic replication as a more efficient way to gain access to either them harder to access markets or markets that are slightly more frictional, whether that be for transaction costs or things, as Ross mentioned, so some of them factors that are underneath that make synthetic replication a much more efficient way for us to access those particular areas.